Good afternoon, everybody, and welcome to our webinar on wealth creation, leveraging opportunities with me, Shelley Palman. Skip to the first slide. Just a disclaimer before we start the webinar today that it's just for information purposes today. The content is not intended as a substitute for regulated financial advice. For that, you need to come and see us. A little bit about me. I'm a financial advisor and strategist here at Enable Me. I've been here for 9 years and feel like I'm a bit of a seasoned campaigner when it comes to various scenarios that clients throw at me. And my job as a money coach or financial advisor with Enable Me is to give my clients confidence, help them to do better than they're currently on track to be doing, to save more and do that faster, get in control, get retirement ready, and I help my clients grow their wealth. This is what we're talking about today. So in this session today, we're going to start by talking about why would you want to grow your wealth? What are some wealth building principles that you can work towards? The importance of understanding your timeline and your time frames in terms of where we need to land and how long it's going to take to get there and how long do we have. We're going to talk about creating a wealth plan that is personalized or tailored to you. A little bit about risk, because with any investment, there comes risk. And the rewards, of course, adjusting your plan and making sure it's flexible and dynamic for your individual goals. And hopefully we have time. We allow a half an hour for these sessions. So hopefully we have enough time at the end to answer some questions. And we'll have some key takeaways as well. So I've already got some questions that have been sent through pre the webinar, but if you think of a question during the webinar today, just pop it into the question box and my producer Amelia will collate those and hopefully we get a chance to cover them off right at the end. Let's crack into it. Why would you grow your wealth? Yeah, lots of different reasons. And I find myself often saying to my clients, to be honest, you have no option but to grow your wealth. Over those working years, we do need to be accumulating because when you stop work, we need to then decumulate the wealth that you've accumulated over your working years. So, you know, we say growing wealth creates more options for yourself and for your family. For a lot of us, it actually improves our financial security. So we have more of a backstop, particularly when the money stops and we're not earning anymore. For a lot of us, growing wealth is to actually solve a problem, and I'm going to talk about retirement shortfalls a little bit later in the session. For some of us, we grow wealth to help our kids and to leave a legacy for our family. For some of us, it's just because we can and we want to be more ambitious. But crucially, it is to fund your retirement. When the income stops, all well and good while you're earning, but when that income stops, what are we going to live off? You have no choice but to accumulate wealth. So what is the problem that we're trying to solve? And in this country, we came a bit late to the whole KiwiSaver thing. So the young ones of the next generation have started their KiwiSaver savings to an extent. But for a lot of us, we started that too late. So at the moment, there's been a lot of research done around this as we have an aging population. And that research suggests that 65% of Kiwis are actually worried that they're not on track. And they're right to be worried. Particularly if they've had something happen in their lives, like a big financial event or a separation or something like that. They're worried about how they're going to afford to live the same lifestyle. 56% of Kiwis don't feel prepared, and that's a bit scary. Well, they don't know what they need to do to be prepared. And 70% of Kiwis think they have to work past age 70, not past age 65, past age 70. And I guess that's on the proviso that, number one, you actually have a job and someone will employ you at that point, or that you're physically capable of doing so. So that's a bit of a scary one, working past age 70. So how much will you need to retire comfortably? This is the $1 million or $2 million or $3 million question. So yeah, it depends. It does depend. You know, what is your lifestyle? I often say to my bigger income earners, you know, it's tricky. It's a double-edged sword, earning good money, because you have the whole lifestyle creep thing that happens. And so once that money stops, it's really hard to adjust back down to that kind of lower level of lifestyle that you've been accustomed to. So it does depend on where you live. So if you're in a metro area versus a rural area, It depends on the lifestyle that you have or that you want, around travel and holidays and ability to socialize and go to restaurants and things like that. It depends on your accommodations. So how much does your house cost you to hold? Is an expensive high maintenance house, or is it a low maintenance apartment? And it depends on whether you want to retire before or after 65. And so a lot of people I speak to when I first meet them say to me they want choices around the work that they do. And that might be from mid-50s, from 60. They want the choice to be able to work. So how much will you need depends on all of these things. But as a rule of thumb, we say to times the annual cost of your life by 25. So this is kind of the rule of thumb. So if you're age 65, we want to take you out as a gold standard to age 90. And if you live past age 90, great. We hope you do. In all likelihood, past age 90, you will have a lesser of an ability to travel. You may not be able to drive, so therefore you have lower costs in terms of cars and things like that. My 93-year-old grandmother lives off the pension. But yeah, the rule of thumb is 25 times your annual living costs. And I have to say, this is where a lot of people get it wrong. So people sit down and they go, well, my life only costs me $35,000 a year, and I'm talking for a singleton. For a couple, that could be on average up to about $75,000 a year as a minimum. What people fail to build in is travel. And that might not be just your normal kind of travel. It might be, hey, I want to take a big Europe trip as soon as I retire, or I want to go to visit my family in America, and I want to be able to do that every third year. How often are you going to replace your car? Are you going to have a bigger maintenance item on your home? If you don't have medical insurance, can you pay for an operation? So all of those things need to be added into the calculation. So we talk about your annual living costs. That's your normal cost of living, but often people forget about those extras. So if you are sitting down and trying to do this without the benefit of a financial expert, please don't forget about those things. So we generally say that your retirement needs or your retirement spend will be about 60% of your pre-retirement income. So if you're earning, for ease of math, 100K per annum, then your spend would likely be 60K per annum. So that's just something you can work to as well. But everyone's different. So what is a wealth plan? And we sometimes call it a wealth strategy. So what is our plan here for growing wealth? So a wealth plan, it's bringing together a range of different asset types. So for most of us, the default position is that we have KiwiSaver, and we absolutely should have KiwiSaver. And that's kind of bubbling away in the background, coming out of our pay. We hopefully don't notice it. That's compounding if you've got a really good KiwiSaver provider. But, what are the other kind of asset types or investments that we could be tapping into? And what is the kind of the hold or the sell strategy around those different assets so that we're going to be able to meet our cash flow needs at certain times or our goals? So when we talk about having a wealth plan in terms of accumulating investments, we absolutely have to make sure that it's flexible and dynamic because life happens. We always have to have a buffer. Even without a wealth plan, we need a buffer for a rainy day because they always happen. You will always have something on the car. There will always be a dental visit that results in something which is expensive. So we need to anticipate that and build in those buffers anyway, but particularly so if we're having building a wealth plan. Behavior and money mindset and spending habits and all of that does feed into it as well. We want our clients or everyone that we talk to have a wealth mindset. And when we talk about a wealth mindset, I often come across a lot of people, and this will happen when they've kind of grown up with not much, and they'll have what we call a scarcity or poverty mindset. And a poverty or scarcity mindset is kind of, they have a lot of fear around money. They have a fear of not having enough. They love to squirrel money away. They're very risk averse. And so it's trying to sort of counteract that and kind of get them more into that kind of ability to see opportunity and to grow their wealth. And we call that the wealth mindset. So being a little bit more comfortable with taking risk and how we can kind of take them on that journey to being more comfortable. So that's what a wealth mindset is to me. And as always, a wealth plan or a wealth strategy should be founded upon a strong sort of base level of financial foundation. So when we talk about having a strong financial foundation, what that looks like is having really healthy money habits. So for those shoppers or spenders out there, understanding that that's your tendency and counteracting that and hacking yourself a little bit. If you are an extreme saver, sometimes we can have habits around saving, squirreling too much and missing opportunities. So calling out what your money personality is, they're working towards counteracting that. We want to make sure we understand your goals in terms of what you need to achieve and by when. So that's part of having a financial foundation. How are you managing your money and getting really healthy kind of systems around managing your money so that you're always saving by default and you're not having to use too much willpower to save. If you have short-term debt, how are we going to manage that and get it paid off? If you have a mortgage, how can we kill that as quickly as possible and in the most interest-efficient way? And are your insurance and your KiwiSaver financial products fit for purpose? So in terms of insurance, are you paying too much or do you have not enough insurance? Or are you insured for the wrong things or for your level of risk? And with your KiwiSaver provider, are they giving you the best returns? What is your level of contribution? And are you in the right fund type? So if you're young, are you in a growth or aggressive fund? If you're kind of heading towards 65, are you in more of a kind of balanced or conservative fund? So talking about how paying your mortgage off faster can help with your wealth plan. So it seems counterintuitive because you're like, but I'm supposed to be growing my wealth. How can I also pay off my mortgage? And there is a really good question that came through about that, which I'm going to address later. But, you know, we look at, and I know the graph looks slightly confusing, but you can see the dotted blue line here. For some of us, sadly, and if you look at your mortgage and you look, if you do have one, and you look at the term or the end date, if it's something horrendous like 2050 something, or, you know, like 2048 or 2052 or something like that, and you're in your 40s, chances are you're going to be closer to 65 when that mortgage is being paid off, unless you accelerate paying it off. So when that happens, and if you are on track currently to pay off your mortgage by age 65, you can see that dotted yellow line there. That KiwiSaver is just not going to be enough. So if we pay our mortgage off 10 years sooner and get mortgage free at age 55, it buys us time. So you can see that green line, that wealth creation. So it could be investing into a managed fund, it could be doing a property, it could be something else, it could be buying a business, you know, whatever your wealth strategy is, but it's accumulating your wealth that by the time you turn age 65, we have more of a shot of being able to make that money last. But what we're really ideally trying to get to is this beautiful red line here, which is making sure that our post-retirement wealth management is sound and that we're getting the returns that we need in retirement to not only beat inflation, but to actually make sure that that money lasts right out to age 90. So lots of different options for growing your wealth. And here at Enable Me, we're very agnostic when it comes to the type of option that you enter into, and they all come with different levels of risk. But I often find that people get very confused. They come to me, should we be investing in ETFs? Should we buy some gold? What about crypto? You know, should we buy a forest? There are many, many options, and the option that you take depends on your situation. How do you choose the best option? So we start by looking at where do we need to land? So that's knowing your retirement number. And when we work with people and we work with our clients in a beautiful retirement plan program that we have, we really crunch the numbers on, are we okay or are we not okay? Is there actually a problem here that we need to solve? So the first port of call is, what are our needs in retirement? The second port of call is, Houston, do we have a problem? And how big is that problem? So then we need to put in place some savings goals to ensure that we're kind of going to start to mitigate that. We need to look at your time horizons. And this is so key with building a wealth strategy. If you're 50 or if you're 55, a whole different time frame to if you're sort of 35 to 45. So how many cycles, economic cycles do we have? When are you going to run out of money? How long can you work for? How long are you prepared to work for? Timeframes are very, very, very important, and we need to pay attention to them. And lastly, what is your tolerance when it comes to risk? And often the people's preference with risk doesn't match with their risk needs. So sometimes they need to take more risk than they're comfortable with, and that can be a hard place to be. But yeah, how to choose the best option in terms of wealth creation, it depends on you and what we're trying to achieve. So talking about balancing risk and return, obviously the lower the risk, the lower the return. So we start with cash, so that would be savings or something like that, or an investment in cash or bonds or something like that, or term deposits. So low risk, low return. So as we go up the blue line, we look at managed funds, property, a little bit more risky, but greater chance of return, shares, pretty aggressive, particularly if you're only investing in just shares, and particularly if your shares are not particularly diversified by country or industry. And being in business is the most risky. It's 100% aggressive to be in business because you're in one company. You hold the shares in that one company, in that one industry. So very, very risky, but the rewards can be greater. So, but you know, the bigger the savings gap for retirement, the bigger risk that we actually need to take. So a little bit about KiwiSaver. Is it still worth it? Absolutely. Yep. It's deducted before you see it. We don't notice it. Your employer contributes if you are employed. If you're self-employed, we generally just get you matching, doing the 1,043 per annum, so you get the money from the government. But definitely it shouldn't be your only option. In New Zealand, it's not quite enough that if we're doing that 3%, and most people will still have a gap over and above their KiwiSaver. And I think one of the big risks with KiwiSaver is that it's locked away until you're age 65. And I don't know about you, but I want to have fun before I'm 65. So I kind of want access to cash before then. So that's one of the risks of KiwiSaver. So what we say here at Enable Me is, if you have a retirement gap that is more than 300K, so despite your best efforts of saving, once you're mortgage free, we're still short by 300K, it's likely you're going to need to use leverage to bridge that gap. So when we talk about leverage, we mean borrowing. And generally that's to buy an asset that's going to go up in value. And in this country, for most of us, that means property. So why property? We like property here because of leverage, not because of property, because of the power of leverage. So over time, a leveraged property will outperform other forms of investment or asset classes by 250%, and it's less volatile. So when you think about the share market and when you start to look back at kind of volatility with shares and compare that to the volatility of property, property actually has a lower, yes, there's still a cycle with it, but it's a smoother trajectory up as opposed to shares, which kind of end up looking like this. So still volatile, but less volatile than some other asset classes. Just to illustrate the power of leverage, you think about, hey, if you're lucky enough to have 160K, maybe you've received an inheritance, that 160,000, you could say, well, why don't I pop that into a managed investment fund? That's going to be lovely and diversified. It's going to give me more returns than putting the money in the bank. And for most balanced funds, we're likely to get an average net return after accounting for fees and tax of about 6%. If you're in a growth or aggressive fund, that's likely to track a little bit higher than that. If you're in conservative or defensive, it will track a bit lower than 6%. But for the ease of the numbers today, I'm going to use 6% because 6% is what the property market has gone up by over the last 30 years in New Zealand. So if you were to take 160K, invest it in a managed fund, you're going to get about 9,600. Amazing. You didn't have to earn that. It's worked hard for you and it's given you nearly 10 grand over the course of that year. However, if you take that same 160K, use that as a 20% deposit on an 800K investment property, the capital growth at 6% is actually 48,000. So you see what I mean by 250% better return on that particular example. But, you know, like with anything, it comes with a risk. So one of the biggest risks or mistakes that people make with property is buying the wrong property. And it doesn't mean that property is necessarily bad, it's just bad for them, for their situation. It might have the wrong capital growth type scenario, or it might have the wrong yield and it's going to cost them too much to hold. One of the other big risks is working with the wrong builder or developer and not building in cash flow contingencies for a bad day. The secret sauce to successful property investing is, number one, making sure you can get the borrowings. Number two, making sure you have enough money to actually hold the damn thing over the whole period. Number three, understanding your hold strategy. How long are we holding this thing for and when should we sell? Knowing when to sell is quite critical. Buying the right property from the get-go for your own circumstances and goals, and being cash resilient so that you can actually weather any adverse conditions, such as high interest rates and high inflation like we've just been through. Just wanted to talk through a quick example, and I want to leave enough time, so I'm going to go through this example quite quickly. These are some clients that I have worked with personally. They are 51 and 55 years old. We crunched the numbers for these guys and we tested this and we tracked their spend, so we understood their happy life spend. We calculated that even if they pay their mortgage off faster, save as much as they possibly can, and do their KiwiSaver, and we compounded their KiwiSaver, they're still short. They do have quite a happy life, I'm not going to lie, but they have a gap of $500,000, just over $500,000. So what we did a couple of years ago, back in 2020, is that they leveraged off the equity they had in their home, and they bought a 3-bedroom investment property in Papamoa for $665K. What panned out over the subsequent couple of years is that the property market went gangbusters. It actually went up to about $1 million within the first 2 years. It's now come back down to about 860. I think I looked it up the other day, their property, and it's sitting at about that 900K mark, actually, market value at the moment. So over the last 4 years, they have actually had over I think around about 200K of capital growth on that property. So they're nearly halfway towards bridging their retirement gap. So we just need to hold for another 10 years with these guys to take them through to age 65, and that should close their retirement gap. So that's a really good example of leverage in action. So to summarize, I guess, from today, we're talking about the best approach in terms of a wealth plan. It depends on your time frame. That's quite key. How long can we work for? When are we going to need access to money? It depends on your goals, your appetite around risk or your capacity to take on risk, your cash flow requirements, and what you have surplus every month. If we're taking on something that requires a top up, like a property, having flexibility and having sort of a dynamic wealth plan, having the ability to access lending. So the older we get, access to lending gets harder. Banks get very ageist as we head into our late 50s, and access to equity. So that might be cash at bank to put in as a deposit, or it might be equity in your family home that we can tap into and leverage off. So key takeaways from the session: what is the problem we're trying to solve? Houston, do we have a problem in terms of a retirement gap? What are the requirements of your investments? How much return do we need? What are your timeframes? What are your risk preferences versus your risk requirements to make sure you get to where you need to be? And as always, work with a trusted expert. So come and see us or another financial advisor that you trust to actually help you to crunch the numbers and look at what these opportunities are for your wealth plan. So we would like to extend an offer to those of you who have listened to the webinar today to come along and see one of our coaches for what we call an initial consultation. So the initial consultation, what that looks like, it's a 60 to 90-minute session, depending on if we need the time. And what we're looking at in this initial consultation is, where are you at now in terms of your asset position? What is your current trajectory, and can we help get you there faster? So it's quite an awesome session to kind of look at, giving you a bit of a steer on what you might have to do. Are we looking like we're going to head into a problem towards retirement? What are the opportunities for you in terms of wealth creation? So quite a cool session. We normally charge $400 for that. But for those of you who book today, you can get that discounted down to $149. And if you book from tomorrow, if you're watching this as a recording, that will be discounted down to $249. So hopefully, Amelia, I've left a little bit of time to go through a bit of Q&A. Have we got some good questions that have come through, Amelia?
Yes, thanks, Shelley. We've picked a few questions from the ones that have been submitted. So
Cool.
Let's get into them.
Yeah,
The first question is it better to pay off your mortgage quicker as opposed to investing in other things?
Yeah,
Do you have
absolutely.
any thoughts on just paying interest and not principal?
Yeah, absolutely. And I get this question all the time. It's a really good one. People go, why would I pay my mortgage off? I could invest elsewhere. So I think if you're considering buying an investment property, We likely will end up attacking the debt on the investment property, but actually, if you have an investment property, the debt associated with that is tax deductible. The debt on your home is not. So a couple of benefits to getting mortgage free on your family home. I mean, it's not tax deductible. We consider it to be dead debt. It's on a lifestyle asset. So the default position is always kill your home mortgage as quickly as you possibly can. And why would you do that? Number one, it's going to reduce your fixed cost load. Oh, gone back to it, sorry, throwing my hands around. It reduces your fixed cost load. So the quicker you can clear your home mortgage, the lower your mortgage repayments are, the less the less you need to earn, so your earnings aren't kind of tied because you've got this high mortgage, you've got these mortgage repayments. So it kind of introduces an element of freedom as well. And also it creates opportunities. So the quicker we can get you mortgage free, we're opening up the opportunity to then leverage off that beautiful equity we've created in your home. So absolutely always, ultimately, by the time we want to kind of retire, we need to be mortgage free anyway, because we need to kind of be able to live somewhere. So yeah, P&I, get rid of that mortgage as quickly as possible. If you've got an investment property, we would park that on interest only while we focus on paying off your home. And for some of us, people like to kind of maybe be, in addition to KiwiSaver, kind of adding to an investment fund or Sharesies or something like that. We can sometimes go, yeah, do you know what? Let's do a little bit of that concurrently with killing our home mortgage, so we can kind of balance out the two. So that's a really good question. Thank you. Next one.
Next one. What are your thoughts on how residential compares to commercial property investment?
Yeah, this is another common question. And I think both are great. And if we can afford commercial, it would be great. Often commercial ends up being a lot more expensive. Risks with commercial are it's considered to be business lending. So often it's really hard to get the lending in the first place. You have to go through the business lending team. It might be on a higher amount. They often put it on principal and interest, and they put it on a shorter term, like a 15-year term. They consider it to be more risky because it's kind of like just one tenant. There could be a gap in terms of tenancy, or if that business that's in that commercial goes into receivership or liquidation, then there could be a big gap. So they want you to get rid of that debt more quickly. So in terms of the hold of that property, it can often introduce quite a high cost to hold. But yeah, I mean, most of my clients, the mum and dad investor, we start with residential. It's more simple. We know it. You can just leverage off, and it's at mortgage interest rates. It's not at a commercial lending rate. And it's just a sort of almost a lower risk, more sort of known quantity of an investment. But certainly if we're looking at, hey, we've already got one or two residential, would we add in a commercial on top of that? Particularly if we're in a position where we've accumulated some residential investments and we've paid down the debt on them and they're kind of cash flow positive, that can kind of help to offset the cost of that commercial. So commercial can be great. The yields tend to be higher, but for most of us, it's not accessible because the lending conditions are quite harsh. So that would be my answer there.
All right. Another question we have, how do we leverage the equity that we have to buy investment properties when the rent on those properties won't cover repayments?
Yeah, and we've just come through a period of time where we've had kind of a scary time, with interest rates on the increase. We feel a little more comfortable now. We can breathe a little bit more because we're seeing lots of commentary around rates, and they physically are coming down now. But yeah, it's likely that the rent will not cover the rates and the insurance and the mortgage interest. So one of the ways of minimizing what we call the rental top-up, because there will be a rental top-up, we should anticipate that. And for most of us, we try and work that into our budget and see what efficiencies we can make within our personal budget to kind of offset that cost. But that's when buying the right property comes into it. So what is the rental yield on that property? How much is this property going to cost us to hold? So the way we mitigate it is we go interest only on the lending in the first instance, and most banks will do that for the first 5 years, and then you can reapply. So going interest only and understanding that the yield of the property is correct for your situation. So what is your tolerance to be able to kind of top up that property? Therefore, what rental yield or rental income do we need from that property to minimize the amount of that property top up? So the higher the yield, the better. balancing that out with kind of, also wanting a bit of capital growth out of that investment. But yeah, there will be a top up, and it's how can we work that into your budget? For a lot of my clients, we talk about minimizing fritter, which is, money that goes walkabout. If we can find that fritter, we can actually put that towards topping up a property and work it into our budget without too much of an issue. But yeah, buying the right property feeds into that as well. So that would be my answer there.
Right. Let's do one last question.
Okay.
This is a question that's just come up.
Okay.
I feel that wealth or wealthy is treated as a bad thing in New Zealand. In conversations with friends, relatives, colleagues, I'm often made to feel guilty for being financially successful. If others are experiencing the same attitude from the associates, how do you suggest they deal with the negative sentiment?
Yeah, and I think if you're talking, it kind of speaks to what I was talking about before around that poverty or scarcity mindset. And it's certainly something I come across a lot with the people I meet, whether it be clients or whether it be just people I'm talking to in general. And like I said earlier in the session today, actually we have no choice but to accumulate wealth. So it's not that we're being irresponsible or we should be made to feel bad by accumulating wealth. If we don't accumulate wealth, it's more likely we might be a drain on society or our children in the future. So that can kind of be a bit of a comeback for you. It's like everyone needs to accumulate wealth because we need to then use that in retirement. That's, to me, that's being a responsible member of society, is ensuring that I can pay my own way heading into retirement and provide opportunity for my children or possibly my family members to be able to not be a drain on society. So I think when people talk about growing wealth and when they have an issue with you being financially successful, it stems from a poverty mindset, and they're not in that kind of mindset of wealth accumulation. They're in that kind of mindset of, I need to save, and it's ridiculous that people are buying property in this country and it's feeding in, it's a complicated conversation around that. But I think that if you look at their background or kind of their own financial situation, I think you'll find that they're sitting in that poverty or scarcity mindset, and they haven't kind of got their heads around being in a wealth mindset. And it's a real behavioral thing, and it can be how you grew up, what you do as a job, the people you surround yourselves in your environment. I think also the answer there would be environment is very important. So, if you're feeling like you want to be financially successful, let's surround ourselves with others that have a similar mindset, because there's more of a chance that you and them are going to be financially successful together, and you move away from those naysayers. And I think we're out of time, Amelia.
Yeah, so it's about time to finish. Sorry we can't get through all the questions. I'll let Shelley close off now.
Yeah, no, that's great. Thank you so much for joining the webinar today. We really appreciate it. Come along and see us for that initial consultation. It could be myself, it could be one of my wonderful colleagues, and enjoy the rest of your day.